Economic value added, or EVA, is a financial measure that helps companies determine if they're truly creating value beyond just covering their costs. It looks at the economic profit, which means the returns surpass what it costs to finance the business. The basic formula compares net operating profit after taxes to the capital employed multiplied by the cost of capital, which is essentially the weighted average cost of capital, or WACC. This metric answers a key question: is the company earning more than it costs to run? From a CFO's perspective, EVA is crucial because it guides how capital is allocated to ensure investments are worthwhile, helps measure the performance of different business units and managers, supports strategic decisions that focus on long-term value creation, and provides clarity to investors on how the company is enhancing shareholder wealth. The image here reinforces this idea by showing growth through upward arrows, symbolizing value creation and positive financial performance. EVA is a useful tool in business for making key decisions. It helps determine if new projects truly add value before investing in them. When linked to management bonuses, EVA encourages leaders to focus on creating value. It also supports portfolio management by highlighting underperforming units that may need restructuring or divestment. For example, Coca-Cola started using EVA in the 1990s to align management incentives and improve capital allocation, which enhanced returns for shareholders. Siemens applied EVA to evaluate their global business units, leading to the sale of non-core assets and a stronger focus on high-value areas. To see how it works in practice, consider XYZ Manufacturing Limited, a mid-sized company evaluating its value creation. Using their financial data, $12 million in net operating profit after taxes, $80 million in capital employed, and a 10% cost of capital, we calculate EVA by subtracting the capital charge from the profit. This results in a positive EVA of $4 million, meaning the company is generating economic profit beyond its cost of capital. This shows that XYZ Manufacturing is successfully creating shareholder value and earning returns above what investors expect. A positive economic value added, or EVA, means the company is creating value beyond its cost of capital, which signals strong financial health. For a CFO, this result supports continuing investments in current projects and can be tied into performance incentives for managers to encourage value creation. However, if EVA were negative, the CFO would need to re-evaluate how capital is allocated, possibly cutting costs or selling off underperforming assets. EVA has some clear advantages. It goes beyond simple accounting profit by focusing on real value creation, encourages efficient use of resources, aligns closely with shareholder interests by ensuring returns exceed the cost of capital, and provides transparent performance metrics for managers and investors. On the downside, calculating EVA can be complicated because it requires making adjustments to accounting numbers, and it relies heavily on accurately estimating the cost of capital. There's also a risk that managers might avoid long-term investments that could initially reduce EVA. EVA isn't universally adopted, which can make comparisons across companies difficult, and it focuses only on financial results, leaving out strategic or qualitative factors like brand value or innovation. Implementing EVA can be costly due to necessary system changes and training, and adjustments to its components can sometimes be influenced by accounting policies, which opens the door to manipulation. Despite these challenges, EVA is a valuable tool for measuring true economic performance. When integrated into financial strategy, it helps CFOs drive sustainable growth, optimize how capital is allocated, and ultimately enhance shareholder value. In today's competitive business environment, EVA should be seen as more than just a metric. It's a mindset that guides value-driven leadership.